Welcome back to the deep dive. We are here to take that complex stack of sources you see, the articles, the surveys, the dense economic texts, and, well, basically transform them into something you can actually use, giving you that shortcut to being genuinely well-informed.
Exactly. We do the heavy reading so you don't have to.
And today, we are tackling an asset that has, it's defined wealth and power for something like 5,000 years, gold. Now, in an age where, markets can swing based on a social media post, where money is becoming more and more digital, and where the gold standard has been dead for half a century, you'd be forgiven for thinking gold belongs in a museum.
Right. It feels like a relic to a lot of people, an analog asset in a digital world.
But here's the hook. This is the thing that really pulled us into this deep dive. Despite the rise of these digital rivals, like Bitcoin, and despite the absolute dominance of unbacked fiat money everywhere, central banks, the very institutions that control all this fiat money, they are accumulating gold at an unprecedented, honestly, a historic rate. We're talking net acquisitions of over 1,000 tons globally in each of the last 3 years, so 2022, 2023, and 2024.
That figure is, it's just astonishing, and it flies directly in the face of that casual assumption that gold is, obsolete. Our look at the 2025 Central Bank Gold Reserve Survey confirms this isn't a fluke. It's a structural shift.
How structural?
Well, a staggering 95% of the central bankers they surveyed believe their global gold reserves will keep increasing over the next year.
95%.
And get this, not a single central bank expects a decline, not one.
Wow. Okay, so if the institutions that literally print money are all rushing back to the oldest form of money, what on earth do they see that we need to understand? Is gold obsolete, or does it still have this vital, maybe even necessary place in a modern portfolio?
That is the central mission for us today. This deep dive is all about simplifying the really complex arguments both for and against gold. We're going to contrast its 5,000-year track record with all these modern pressures, high global debt, geopolitical chaos, and, of course, the challenge from crypto.
And we're pulling from everything, right? Historical cycles, the philosophical arguments for honest money, and a really hard look at what's driving the current market and its warning signs.
Exactly. Our goal is to give you a framework for understanding gold's enduring or maybe dissolving role in a world that's defined by, well, unconstrained fiat currency and a whole lot of instability.
Okay, let's unpack this. Before we even get to why central banks are hoarding gold in 2025, we have to go back. We need to build that philosophical foundation, this whole idea of honest money.
It's the essential starting point. The contrast is, it's really fundamental. On one side, you have what's called honest money.
Right.
That's a medium of exchange that's redeemable. It's measured by a fixed, known standard, like a very precise weight of gold or silver.
Okay, so it's tied to something real.
Exactly. And on the other side, you have what we live with today, politically manipulable fiat paper money. It's unbacked. It's sustained only by government decree, government saying this has value and the public's faith in that promise.
That immediately sounds a lot less stable. Where did this idea, this sort of constitutional concept of money, even come from in the U.S. context? The source material takes us way back, right?
It does. Right back to the foundation of the Republic. And the debate was, believe me, fierce even then. Thomas Jefferson put it perfectly in 1784 when they were debating the creation of the U.S. dollar. He said, I'm quoting here, if we determine that a dollar shall be our unit, we must then say with precision what a dollar is.
With precision. So what was a dollar, precisely?
Well, legally, from the Coinage Act of 1792 all the way up until 1971, the dollar was defined by a specific weight of precious metal.
For almost 200 years.
Yes. That fixed definition meant that the government's ability to just, arbitrarily increase the money supply was severely constrained by physical reality. You can't just print more gold. You have to find it and dig it out of the ground.
So that was the whole point of the gold standard. It was a check on political power.
It was a self-imposed restraint. Exactly. But the philosophical argument, it goes even deeper than just monetary policy. It actually links that restraint on government spending directly to individual freedom.
How so?
Well, thinkers like John Locke argued that property rights, and that includes the right to own and transact in real, unadulterated money, were essential civil liberties. They put it on the same level as freedom of speech or religion.
So owning gold was like a basic...
That was the idea. The Founding Fathers, they had seen the absolute ruin caused by the fiat paper money of the Continental Congress during the Revolution. So they explicitly restricted legal tender to gold and silver in the Constitution because they just did not trust unchecked political control over the currency.
So the core argument laid out in the case for gold is that our system today, the one run by a centralized banking monopoly like the Federal Reserve since 1913, it completely undermines that original principle.
That is the crux of their indictment, yes.
Hmm.
They argue that the current fiat system essentially allows the government to engage in a form of taxation without representation.
Okay, unpack that. How is printing money a tax?
Well, when the Fed creates new money out of thin air to finance government deficits,
Right.
it dilutes the value of every single dollar that already exists, the ones in your savings account, the ones in a retiree's pension. It's a stealth tax. The government gets to spend all this new money without ever having to pass politically toxic legislation to raise income tax rates.
Wow, that's a really powerful way of looking at inflation. It's not just some unfortunate side effect, it's an actual policy tool.
It is. The moment you remove that physical and you could say moral constraint of gold, the political incentive to just print money to solve every single fiscal problem becomes overwhelming. The source material is very blunt about this. It says the institutionalization of money-creating powers cannot perform the economic miracle of turning stones into bread.
It just makes the existing loaf smaller for everyone else.
Precisely.
Let's talk about the moment the U.S. finally, systematically, severed this historic link. It wasn't just one event, was it? It was more like a series of broken promises, starting back in the 1930s.
That's right. The first really big step was in 1934 under President Roosevelt.
Yeah.
In what was a stunning executive order at the time, the government literally confiscated privately owned gold.
They just took it.
They just took it. And simultaneously, they devalued the dollar from $20.67 per ounce to $35 per ounce. That was a direct one-third reduction in the dollar's value against its historic anchor. That was really the beginning of the end for public trust.
Okay, so that damaged the link for everyday people. But the final fatal blow came much later. What exactly happened on August 15th, 1971?
That was the day. That was when President Nixon went on television and unilaterally suspended the international convertibility of the U.S. dollar into gold. This was what killed the Bretton Woods system.
So before that, other countries could still trade their dollars for U.S. gold.
Yes, foreign central banks could still show up and redeem their dollar holdings for gold at that fixed $35 an ounce rate. When Nixon closed that gold window, as they called it, he severed the dollar's very last tie to any physical commodity.
And that really kicked off the era of pure fiat currency globally. What were the immediate consequences for, the average person's purchasing power?
They were severe. The analysis in the sources shows that the dollar, which was now completely undefined and based purely on government discretion, was worth only about one-third of its prior value within a decade of that final break. The loss of a defined monetary unit created the chronic inflation that has really plagued the economy ever since. It institutionalized that inflationary psychology and lack of trust that, frankly, we're still dealing with today.
Okay, so that's the historical case. But I have to ask the obvious counterargument. If gold is so fundamental, how have major economies survived, even thrived, under fiat systems for the last 50 years? Why isn't that discretionary policy seen as an advantage?
And that's a necessary challenge to the argument. Modern proponents of fiat money, Keynesian economists, will argue that the constraint of gold prevents necessary government action,
Like what?
like stimulating the economy during a recession or quickly financing a war. They claim that discretion, the ability to print, allows for flexibility and better management of economic cycles.
Which sounds reasonable on the surface.
It does. However, the historical evidence presented in our sources suggests this flexibility inevitably, almost always, leads to abuse. Discretionary policy over the long term results in prioritizing political self-interest, financing deficits on the cheap over maintaining currency stability for the average citizen. And that, ultimately, is why the central banks themselves are quietly stocking up on the one asset that takes that discretion away from them.
That's a fascinating irony. So the moral arguments for gold really get their weight when we zoom out from, the year-to-year inflation numbers and look at these huge systemic cycles.
Exactly. The rise, the peak, and the inevitable decline of great nations and their currencies. This gives us the macro context for why gold is making such a big move now.
And this brings us right to the framework developed by investors like Ray Dalio. He argues that gold's relevance is fundamentally tied to the decline stage of an empire cycle.
That's it. Dalio's core, and it's a very humbling observation, is that, and I quote, "No system of government, no economic system, no currency, and no empire lasts forever." He mapped out what he calls an archetypal big cycle that tends to span about 250 years. It shows these patterns that just repeat over and over again throughout history.
Let's walk through the phases of this cycle because it's so important for placing our current system in, some kind of historical perspective.
Okay, so the cycle starts with the rise phase. This is often after a major war or some kind of restructuring. This period is characterized by peace, low debt, rising productivity, small wealth gaps. These are generally good. The currency is strong, trusted, and often backed by a hard asset.
And then comes the top.
Right. This is the peak of wealth and power. But the systemic rot has already started to set in. You see high government and private debt, massive wealth and political gaps, and an overextended military trying to maintain its global dominance. Trust in the currency starts to erode, at least internally.
And finally, the part nobody wants to talk about, the decline.
The decline. The accumulated excesses basically break the system. You see major financial crises, internal conflicts, and often a transition to a new global order, which is frequently accelerated by a war or revolution. And crucially for our discussion, the currency typically collapses or is massively devalued during this phase.
So based on that historical roadmap, where does the United States stand today?
Well, the data suggests the U.S. trajectory, roughly 100 to 150 years after its peak post-World War II, lines up worryingly well with these historical decline patterns.
What are the signs?
Record high government debt, for one. Wealth and political gaps that are widening to levels we haven't seen since the 1920s. And of course, increasing geopolitical challenges to the existing U.S.-led world order.
And that's the big picture, the 250-year cycle. But the actual mechanism that kills the currency is shorter, right? The long-term debt cycle.
Yes, that cycle is about 50 to 100 years long, and it's really the executioner of unbacked fiat currencies. It starts with a big burst of credit, which feels great, it accelerates growth, but eventually the debt levels become completely unsustainable.
And the government faces a choice.
An impossible choice. They can choose austerity, which means a deep economic depression, or they can choose to print money, which means inflation. And since austerity is politically suicidal, the choice is always inflation.
The path of least resistance.
Every time. The cycle always ends with the printing of excessive amounts of fiat money, and that leads to a massive devaluation. Historically, a return to hard money, or a new currency defined by some standard, was the only way to restore public confidence after a collapse like that.
And the track record for fiat currencies is, well, it's pretty damning here.
It is. The source material points out that all major currencies have either been devalued significantly or died altogether over the last few centuries. Even the most powerful ones, like the US dollar and the British pound, have lost over 90% of their purchasing power since 1850.
And gold.
Gold, because it's a non-productive asset that simply cannot be printed, it just retains its purchasing power across these cycles. It's the ultimate yardstick.
Okay, let's dig into this debt trap a bit more. Governments today have debt levels that are, they're mathematically impossible to repay in real terms. So how do they manage this without just triggering an immediate crisis? This is where financial repression comes in.
Financial repression is the government's favorite tool for a stealth default. It is a very effective way to liquidate colossal amounts of debt without the political backlash you'd get from, say, hiking taxes or slashing spending.
How does it work? And more importantly, who loses?
So it involves the government enforcing policies, usually through the central bank, that cap interest rates. They keep them artificially low, very often below the actual rate of inflation.
Give me an example.
Sure. Let's say the prevailing inflation rate is 5%, but the government makes sure that short-term bonds only yield 2%. Your real rate of return is negative 3%. The government is effectively paying back its debt with money that is continuously losing 3% of its real value every single year.
And the losers are?
The losers are savers, retirees on fixed incomes, conservative fixed income funds, and pension funds that are legally required to hold these low-risk government bonds. Their capital is just slowly, silently being confiscated by inflation. This allows the government to effectively default on the real value of its debt over a decade or two.
And this isn't some new crazy idea. This has been done before.
Oh, absolutely. This technique was used extensively after World War II to liquidate the huge wartime debts across both the U.S. and Europe. It's a historically proven political strategy for escaping a debt trap.
So in this kind of macro environment, high debt, the inevitable move towards financial repression holding gold isn't just an investment, it's a defensive measure.
Precisely. It becomes a necessary defense. Gold serves as an insurance policy against these stealthy forms of debt default, against capital controls, and against the wealth taxes that often pop up in the late stages of a dying debt cycle.
We've laid out the philosophical case, the big cyclical case for gold. Now let's pivot to the here and now. Let's analyze the really complex market dynamics that are driving its surge to all-time highs in the mid-2020s. I mean, the price moves have been just dramatic.
They have. And the core appeal is, of course, timeless. Gold is tangible, it's finite, it's recognized everywhere. But its recent breakout is this really complex interplay of modern forces. We have to start with its historical link to inflation.
Right. Our sources look at the charts, and the biggest gold rally of the 20th century was in the 1970s, which clearly mirrored the peak in inflation during that decade. Is that same pattern repeating today?
It is, in spades. The sharp acceleration in the gold price since 2020 directly tracks the sharp and, more importantly, persistent acceleration in the U.S. inflation rate. It's just a confirmation of gold's function as the ultimate hedge against currency debasement.
So investors and institutions are basically running for shelter.
Explicitly, they're looking for shelter as their fiat currency. In this case, the U.S. dollar is actively losing its purchasing power right before their eyes.
But the road to these new all-time highs wasn't a straight line. The analysis details a pretty significant tug-of-war that started around 2021. What were the two sides in that fight?
So the primary force, acting as a major headwind in 2022 and into 2023, was high U.S. interest rates. The Federal Reserve was aggressively hiking rates to try and fight inflation.
And that's bad for gold because...
Because it raises the opportunity cost of holding gold. Gold is a non-yielding asset. It doesn't pay you any interest. So when government bonds or treasury bills are suddenly yielding 4 or 5%, holding gold becomes less appealing. That really capped the upside for a while, even with high inflation fears.
And yet gold was incredibly resilient. It didn't collapse. And by mid-2023, the price started climbing sharply, even before the Fed started talking about cutting rates. So the structural tailwinds must have finally overpowered that interest rate drag.
Exactly. And those structural tailwinds are twofold, and they're very powerful. The first is that persistent or sticky inflation that is just refused to go back down to the Fed's 2% target. That continuous erosion of the dollar's value provides a continuous, relentless, fundamental push for gold. Because real interest rates, that's the nominal rate minus inflation, they remain historically low or even negative.
And the second tailwind.
This one is becoming more and more important: geopolitical and political risk. Our chart analysis points to non-monetary events as the real catalyst for that final sharp surge from late 2024 into 2025.
Like what kind of events?
Major regional conflicts, the intense U.S. presidential election cycle, and this acceleration of trade wars and protectionist policies, all of it.
So it suggests that global uncertainty and just a general fear of the system breaking down are now the dominant drivers. What do we make of that 2025 comment from ECB President Christine Lagarde about gold's rise?
That quote is highly significant. Lagarde described gold as the ultimate destination for safe haven assets, and she explicitly linked its rise to the U.S. dollar's eroding dominance in the global system.
So you have a G7 central banker basically saying, we're losing faith in the world's reserve currency.
That's essentially what she's saying publicly. That systemic trust is fading, and that's compelling capital to seek refuge in the oldest, most neutral asset there is. The extreme price move is therefore being driven by this global system-wide anxiety.
Okay, that crystallizes the fundamental strength. But now we have to pivot to the technical side of this breakout. Because while the long-term fundamentals seem bulletproof, the short-term market structure is screaming caution. We have to unpack these technical warning signs.
Absolutely. We need to analyze 3 key indicators that measure capital flow, momentum, and speculative positioning. Let's start with the clearest one, which is the capital flowing into the SPDR Gold Shares ETF, ticker GLD.
And how does the money flowing into GLD validate this almost parabolic surge?
Well, GLD is the single biggest gold ETF. It's a proxy for massive institutional and retail money entering the market. And the analysis confirms that this near vertical price move in 2024 and 2025 is being fueled by massive, consistent new capital pouring into that ETF.
So it's not just a short-term blip.
Not at all. The inflows are sustained. And we can even confirm this conviction by looking at something called the Chaikin Accumulation Distribution Oscillator.
Okay, break that down for us. What does that oscillator actually measure?
So this oscillator isn't just looking at price. It's confirming whether the trading volume is truly supporting the upward move. A positive reading confirms that strong buying pressure is accumulating at the high end of the daily trading range. It indicates that big institutional buyers are committed to this trend. The money flowing in is real, and it's strong.
So the inflow confirms the fundamental story, but the warning comes from how fast the price has moved. Let's talk about the money flow index, or MFI.
Correct. The MFI is a volume-weighted momentum oscillator. It looks at both price and volume to show buying and selling pressure. And for GLD, the MFI has surged into the extreme overbought zone in 2025. It's nearing a reading of 90.
And what does an MFI reading of 90 historically tell us?
It confirms that the market is highly extended. Momentum just cannot sustain this kind of near-vertical parabolic rise without resting or consolidating. So while the inflows are bullish for the long term, this reading is screaming that in the immediate short term, the risk of a sharp correction, a painful pullback to shake out the weak hands, is historically elevated. The market has run too far, too fast.
And finally, the futures market positioning. This often gives us the most powerful contrarian signal, right? The commitment of traders, or COT report. This is the classic measure of smart money versus speculative money.
The COT report tracks the net positions of different trading groups, and we focus on the divergence. So you have managed money, which is hedge funds and CTAs. They're the trend followers, the speculators. Then you have the producers and merchants, the actual miners and refiners. They're often called the smart money because they know the physical market better than anyone.
And what divergence are we seeing right now at these all-time highs?
We are seeing a classic textbook contrarian warning sign. As the prices exploded higher, the managed money, the speculators, have become extremely net long. They are fully leveraged, all in on the bet for continued upside.
And the producers, the smart money.
Conversely, the producers and merchants are holding an extremely large net short position. They're selling their future production forward because they believe the current price is a fantastic opportunity to lock in high profits. They are betting on a short-term price drop.
So the people who physically dig gold out of the ground are taking the exact opposite bet from the speculators at this very moment.
That is the critical takeaway. This massive divergence indicates a very high risk of price exhaustion or a sharp pullback. When the price is making all-time highs and the entire speculative community is positioned on one side of the boat, it suggests that market is highly vulnerable to cascading profit-taking at the first sign of trouble.
Okay, so to sum up this section, the fundamental reasons to own gold-sticky inflation, geopolitics, central bank buying are maybe stronger than they've been in decades, but the immediate technical risk of a really brutal but necessary correction is also extremely high.
It's a clear late-stage bull market scenario. The structure is sound, but momentum-wise, it's dangerously extended, and it's ready for a breather.
Okay, so gold is wrestling with history, with fiat money, but it also has this new, purely digital rival for the title of ultimate safe haven, Bitcoin. This feels like the modern version of that honest money debate, just swapping physical weight for decentralized code.
It's a fascinating and, frankly, a necessary comparison, especially for any investor trying to build a portfolio for the 21st century. It forces you to decide what attributes really define a store of value. It's a tale of two safe havens, each one appealing to different needs and different technological convictions.
Let's start with the advantages that keep gold relevant despite this digital revolution, the classic case for the metal.
Gold's edge is just overwhelming when you look at track record, institutional acceptance, and its physical nature. I mean, we're talking about 5,000 years of global recognition.
Right.
It has fully regulated, established custody solutions. It offers relative stability, far less volatility, which is absolutely critical for big institutions like pension funds. And the 2025 data shows these institutional investors are still decisively choosing the metal. They increased their gold positions by 12% in a recent quarter. It is, at the end of the day, the known quantity.
Okay, so on the other side, why do its proponents always call Bitcoin digital gold? What are its unique selling points?
Well, Bitcoin, in theory, solves the very problem that the fiat system created. Discretionary printing. It's decentralized. No single government or central bank can manipulate its supply. It has a mathematically fixed supply, strictly limited to 21 million coins, which offers provable programmatic inflation protection.
And for the digital generation.
For them, it also provides 247 liquidity and borderless transferability, which is a massive advantage over trying to move physical bars of metal across continents.
So the comparison really boils down to confidence versus code.
I think that's a great way to put it. Gold requires confidence in established institutions and custody. Bitcoin requires confidence in distributed cryptography.
A key question for anyone building a portfolio is whether these two are true rivals, competing for the same dollar, or are they complementary assets that are hedging different kinds of risks? What's the data say about their correlation?
Recent data suggests they are much more complementary than competitive. During periods of severe market stress like the initial COVID crash or various geopolitical shocks, gold and Bitcoin have often moved independently, or shown a very low correlation.
Interesting.
It suggests they're hedging different types of risk. Gold hedges that classic geopolitical and fiat debasement risk, while Bitcoin hedges technological centralization risk, and it offers a high beta bet on the future of decentralized finance.
So the answer for a modern portfolio isn't necessarily a zero-sum game of one or the other, but a strategic allocation to both.
That is the clear emerging consensus among professional portfolio managers. Our sources point to a balanced allocation strategy, dedicating a core 5–10% allocation to gold for its tested historical safe haven characteristics and stability.
Okay.
And then a smaller, more strategic 1–3% allocation to Bitcoin as a speculative hedge on the long-term disruption and adoption of decentralized money.
In the end, what's the single most decisive factor for an individual investor trying to choose between the two?
Volatility. That remains the critical differentiator. If you are risk-averse and your priority is capital preservation above all else, gold has to be your primary choice. Its relative stability is just in a different universe from Bitcoin's enormous price swings, which can be 10 to 20% in a matter of weeks.
Right.
Gold remains the tested safe haven for the truly risk-averse. Bitcoin serves as a high-conviction speculative hedge for those with a much, much higher risk tolerance.
And I assume the regulatory environment still plays a huge role.
A massive role. While the regulatory picture for Bitcoin is improving, gold maintains a significant advantage as a fully regulated, globally recognized asset class in pretty much every major jurisdiction. And that's why the central banks, despite all their talk about digital innovation, are still exclusively buying the metal.
To really appreciate the historical role of gold, we have to understand the gold standard not just as a monetary system, but as a commitment mechanism. Our sources go deep into this idea that sticking to gold was all about building credibility capital, a public trust that governments could then borrow against.
This is such a crucial historical lesson. The gold standard worked when it was understood as a simple binding rule, not as some flexible guideline that was subject to political whims. Specifically, it was treated as a contingent rule.
Okay, help me visualize that contingent rule. How can it be both a fixed standard and something you temporarily abandon?
Well, a contingent rule meant that the authorities could temporarily suspend that fixed price convertibility. They could abandon the gold backing, but only during a severe national emergency, which almost always meant a major war.
Okay.
But the public, the markets, the government itself, they were all absolutely committed to the rule that convertibility at the original pre-war parity would be restored as soon as the emergency was over. This ironclad commitment is what allowed them to borrow enormous sums of money quickly, because creditors believed they would eventually be repaid in hard money.
And England gives us two really powerful examples of this commitment, especially during the Napoleonic Wars.
They do. During the Napoleonic Wars from 1797 to 1821, England temporarily suspended specie payments. They went into what was called the suspension period. They financed the war with debt and unbacked paper money. But the sources emphasize that this was explicitly seen as a temporary deviation, a contingent rule, not a permanent abandonment of the system.
And that commitment to return to the original price was the key, even though it took them years after the war ended.
Precisely. Resumption was delayed multiple times because of political opposition from groups like farmers, who were actually benefiting from the wartime inflation, and they feared the deflationary pain that was necessary to restore the pound to its original gold value. But despite all that political toxicity, the successful resumption in 1821 was this enormous investment in credibility capital. It proved their commitment was real.
And that credibility paid off big time, decades later during World War I.
They ran the same playbook, almost exactly, in 1914. They financed a huge share of their expenditures with debt, relying explicitly on the market's memory and belief that the government would, once again, eventually return to the old parity.
And they did.
They did. The successful resumption in 1925, despite requiring incredibly painful contractionary policies, it just confirmed this credibility. The sources detail the political sacrifice involved. Winston Churchill himself knew the deflation was politically toxic, but he prioritized the long-term benefit of trust. That proven willingness to stick to the rule allowed the government to keep borrowing at favorable rates in future crises.
Okay, now let's contrast that with the U.S. experience during the Civil War. The Greenback episode. This shows the ferocious internal battle over this very idea of discretion.
The Greenback episode is fascinating. It started when the Union, needing to finance the war, issued these unbacked paper notes, the greenbacks, with the presumption of eventual convertibility. But the political debate that followed just defined post-war America. It pitted the hard money forces, who wanted an immediate return to gold against the soft money forces, who loved the discretion that paper money gave them.
So it was a pure political fight over sticking to the rule versus keeping the inflationary engine running.
It was. Congress was constantly reversing itself. They passed a Contraction Act in 1866, then repealed it in 1868. But eventually, the hard money side won out. They passed the Resumption Act of 1875, which led to the actual return to gold parity on January 1st, 1879.
So even with all that turmoil and flip-flopping, how do we know the markets actually believe the U.S. would do it?
We look at the bond markets, specifically something called the negative interest differential. It's a complex way of measuring the difference in yield between U.S. government bonds that paid out in gold versus those that paid out in greenbacks.
Okay, so for our listeners, how does that prove public trust?
Well, if investors believed the greenback would just stay fiat forever, then greenback-paid bonds should have offered a much higher interest rate, a risk premium, than gold-paid bonds.
Right, because they were riskier.
But the opposite often happened. The analysis showed that the difference in interest rates, the discount investors were willing to accept on the greenback bonds, it reflected the public's strong belief that the government would eventually restore parity. The market was basically pricing in the return to gold.
That's a powerful point. The market was willing to take a lower yield on the risky paper bond because they trusted the government's ultimate commitment to gold. Now, let's look at the flip side. A country that completely failed to build this trust. Italy.
Italy is the perfect contrast. The new Italian state adopted the gold standard in 1865, but abandoned convertibility the very next year. They were officially on the gold standard for long periods, but suspended it for more than half the time between 1866 and 1914. They used the contingent rule as an excuse for continuous discretion.
And the market punished them for it?
Severely. We can actually quantify this failure by looking at the risk premium on Italian government bonds relative to highly credible French bonds. During Italy's first long period of inconvertibility, the risk premium charged by international markets averaged more than 2% per year.
So that 2% was basically the cost of Italy's lack of credibility. The market charged them more to borrow because they didn't trust them to repay their debts and sound money.
It proves that adhering to the rule, the political sacrifice of painful deflation that the British endured, was essential for getting favorable access to international capital markets. The simple, transparent, and binding nature of the gold standard was designed to prevent the very discretionary political manipulation that Italy embraced, and which modern fiat systems enable globally today.
So while the gold standard is long gone, the principle is still there. Credibility matters. And the massive accumulation of gold by central banks today is like this quiet acknowledgement that the current fiat system, driven by political discretion, is severely lacking in that same credibility capital.
Okay, we have covered a tremendous amount of ground here. From Jefferson's philosophy all the way to the complexities of the COT report. Let's try and translate all of this into some practical, actionable takeaways for you, the listener, trying to navigate this complex world.
Our first, and I think most important takeaway has to be this. Understand your portfolio's why. You absolutely must define the exact function of gold in your strategy before you allocate any capital.
Right. Is your gold allocation a long-term hedge against that potential fiat currency debasement we talked about, the big macro factors like debt and money printing? Or is it more of a tactical, shorter-term hedge against acute geopolitical risk or election cycles? Your specific why has to dictate your allocation size and your emotional willingness to hold on during those inevitable sharp corrections. Second, define your risk tolerance in the digital age. We've seen that Bitcoin and gold are increasingly viewed as complementary, but the choice between them is a fundamental risk assessment.
So if stability, established custody, and institutional recognition are what matter most to you, if you prioritize proven safety, then gold remains your core, tested safe haven. But for those who are betting aggressively on that long-term technological adoption and can stomach extreme volatility, those 10 to 20% swings in a few mooks, a small strategic allocation to Bitcoin can be a complementary, high-risk hedge.
Our third takeaway is to watch the debt and the gaps as your key macro signals. Pay acute attention to those vulnerability signals from Dalio's big cycle framework. Unsustainable government debt levels and those widening wealth and values gaps within society.
Because these are the historical indicators. They are the fundamental drivers that compel governments to choose currency debasement, that silent default through financial repression, over the politically painful choices of hiking taxes or cutting spending. When these signals intensify, the need for hard, non-sovereign assets like gold for true wealth preservation becomes critical.
And finally, our fourth takeaway is immediate and tactical. Expect the correction. While the long-term, multi-year bull market in gold is supported by the strongest possible fundamentals, sticky inflation, geopolitical risk, the technical indicators we dissected, especially those extreme overbought readings and the contrarian signal from the COT report, are all warning that the current parabolic rise is simply overextended.
So be prepared for a historically high probability of a sharp, maybe even brutal, near-term correction before the next major rally can begin. Fundamentals drive the long-term trend, but technical exhaustion dictates the short-term volatility. This is where your conviction really gets tested.
We've done a really deep dive into the historical and modern case for gold. And I think we saw that its relevance isn't about nostalgia or tradition. It's about systemic risk. It's about the consequences of unconstrained political power over money. When governments inevitably break their promise to maintain currency value, gold reasserts its function as the ultimate safe haven.
And the current bull run is clearly not random. It's a direct, calculated reaction to persistent fiat debasement, escalating geopolitical uncertainty, and the tangible evidence we see through central bank actions of the U.S. dollar's eroding dominance in the global system.
The history of the gold standard suggests that adherence to a simple, transparent rule was the best way for a nation to build that credibility capital.
So, in a world now defined by complex, highly discretionary digital and fiat money, let us leave you with this final provocative thought to reflect on. If history shows us that every government eventually succumbs to the temptation to print money, and if a better, simpler commitment mechanism hasn't been adopted since 1914, what is the inherent and enduring value of holding the only asset that has consistently held policymakers accountable over centuries?
It's a question of trust, and clearly the central banks are voting with their vaults.
We encourage you to really consider the implications of the big cycle for your own long-term wealth strategy, and to check out the links to Ray Dalio's framework and the World Gold Council survey in our show notes. We'll see you next time.